Welcome to the chapter on risk and return. It's a two-part series. Following are the learning goals of this chapter. First, we will try to understand the meaning and fundamental of risk return and risk preferences. We're going to look at the procedures, how to assess and measure the risk of a single asset. Then we are going to look at the measurement of return and standard deviation for a portfolio. Standard deviation basically is the risk of a portfolio and the concept of correlation. Finally, in this part, we are going to look at the risk and return characteristics of a portfolio in terms of correlation and diversification and the impact of international assets on portfolio. Now, what are the risk and return fundamentals? We use these terms very frequently in our daily lives. In making business decisions, there are two key financial considerations as well: risk and return. So you might have heard the terms high risk, high return. If you go for a venture and it's a highly risky venture, then everyone would say obviously the risk is high, but you will get a high return as well. Similarly, if you take low risk, you're going to receive less return. Now this is something we use in our daily life, and the same is applicable in when we are making financial considerations. So each financial decision presents certain risk and return characteristics, and the combination of these characteristics can increase or decrease a firm's share price. So, for instance, if I have a share price, and this share price is going to is denoted by P, the price will increase. The price will increase if the risk increases. The price of the stock will decrease if the risk falls. This is because the risk creates premium, and that's premium or gain. Premium is a compensation for the risk taken. So if someone takes risk, there has to be a premium attached to it, and that premium represents a compensation for the risk taken. High compensation will be offered for high risk, low compensation will be offered for low risk. We'll look into this a little later. Analysts normally use different methods to quantify risk, depending on whether they are looking at single asset or a portfolio. A collection, which portfolio obviously represents a collection or group of assets. So you might have a portfolio of photographs, a portfolio of coins. Similarly, we have a portfolio of stocks, portfolio of bonds, portfolio of any other securities or assets. Let us define risk and return more formally. Now, a risk is a measure of uncertainty surrounding the return. You have to be very clear about the concept of risk. So risk can be positive and can be negative. What is positive? So it's basically variability of returns. So return R can increase, and it also can decrease. So normally we think of risk as only negative. We have this phenomena attached in our brain with the risk is that something bad will happen. However, risk is estimated through variability of returns. So something that can go up as well can go down. Something that can increase can also decrease. So the decrease part has more impact, and hence we look at this part because decrease means a loss, and we as humans are more conscious about the loss than the gains. And there are so many theories on this which we'll look at later or maybe in higher sessions. So risk is not just negative, it's also positive. So if you take risk, you can make more money, but also you should be ready to accept more losses. So it's a two-edged sword. Now, return, it is the total gain or loss experienced on an investment over a given period of time. So we can calculate it by dividing the asset's cash distributions during the period plus the change in value, which is measured by its beginning of period investment value. So let's look at how the return is calculated. So return, for return we have RT equals to the cash flow at time t plus the PT minus PT minus 1, which is the price at time t minus price at t minus 1, which is the last time period, last day, last week, or last month, whichever frequency we are using, and then we divide it by the price t minus 1. Now cash flow, normally you have used this term cash flow by the term dividend with and represented with DD, dividend, and we will convert this cash flow term or symbol to DT later on, but right now we go with the book and it says cash flow, and it can be any cash flow. In terms of stocks is dividend, and in bonds it's interest rate, etc. So from instrument to instrument it varies. This cash flow is basically the cash flow received from the assets investment in the time period t minus 1 to t. Then we have PT, which is the value of an asset at time t, and then we have PT minus 1, which is the price of asset at time t minus 1. Now please look at some of a couple of important things. If the if the PT minus 1, if the price increases and everything remains constant, the returns is going to fall. If price falls, the return is going to increase. So please just keep this in mind. There's an inverse relation between return and price. So return will be moving like this, keeping other things constant. That higher price will yield to lower return, and lower price will leads to higher return. The impact or the interpretation or consequences of this relationship will be much more clear when we are working with pricing or making investment decision whether to buy or sell the stock. Now we have a question at hand. Robin wishes to determine the return on two stocks she owned in 2012 at the beginning of the year. So this is the beginning of the year, which is what we call time t. Apple stock traded for 411.23 per share, and Walmart was valued at 60.3. So at time t the prices were 411 and 60.3 for Walmart. During the year, Apple paid dividends of 5.3. So this is the cash flow CT that we, and Walmart shareholders received dividend of 1.59 per share. At the end of the year, Apple stock was worth 532.17 and 68. These two are price at t minus 1. So now if I have to calculate the price of the Apple stock, so it will be 5.3 plus 532.17 minus $411.23, and if I divide it by 411.23, so this is basically the cash flow. This is price at t, and this is price at t minus 1, and this is also price at t minus 1. We'll get 30.7%. So if Walmart, for Walmart it is $1.59 plus 68.23 minus 60.33. If I divide it by 60.33, comes out to be 15.7%. Again, this is CT plus PT minus 1 divided by PT minus 1. So this formula is going to be used a lot. These are the historical returns on selected investments from 1900s to 2011, and you can see that the treasury bills, treasury bonds, and common stocks have a nominal return of 3.9%, 5%, 9.3 compared to average real return, which is 0.9, 2%, 6.2. Now, what is the difference between nominal return and real return? It's interesting that nominal includes inflation, while real return doesn't. This gives us a somewhat similarity formula, which can be that we have the real return plus inflation, which will be equals to nominal return. And we can see from this that treasury bills pay the least because they are least risky. Treasury bonds pay little higher because they are long run and they have kind of risk associated with it, uncertainty because of length of the time. And common stocks are highly risky, but they also offer highest return. So uh, let's categorize investors and based on their response to risk. So there are, and you can also look at the same and apply the same type on yourself and try to think of it which category you will fall in. For instance, risk averse. Risk averse is the attitude towards risk in which investors would require an increased return as a compensation for an increased risk. So this is high risk, high return, low risk, low return. So this is the kind of type of investors would fit in. Then we have risk neutral, is the attitude towards risk in which investors choose the investments with the higher return regardless of its risk. They really don't bother what type of risk this is. Could be high, it could be low. They are looking at return. Their focus is at return. And then there is risk seeking category of investors. Now these investors actually look for risk and they don't really look at returns, that what type of return is offering. They are just looking at high risk and they invest in high risk or highly risky instruments. Then there are certain other definitions, for instance, scenario analysis. We did it in the last chapters. Scenario analysis is an approach for assessing risk that uses several possible alternative outcomes to obtain a sense of variability among returns. So it could be the expected, which is most likely. Normally we call it average. We have also a pessimistic or worst case scenario, and then we have an optimistic best case scenario. So we'll look into this in a moment. Then we have range. Range is a measure of an asset's risk, basically a distance between maximum and minimum. So it is found by subtracting the return associated with pessimistic worse outcome from the return with the optimistic outcome. So it's basically the max minus minimum will give you a range. It gives you a sense of how far the how much the returns are spread. The higher the range, the more risky it is. The lower the range, the less risky it is. However, we have um, more or better measures to determine the risk that we'll look into next few slides. So let's start with this example, and we are going to follow through this example in the entire chapter. And NC wants to choose the better of two investments, A and B. Each requires an initial outlay of $10,000 and each has a most likely annual return of 15%. So they are almost comparable. However, what are the differences? So asset A appears to be less risky than asset B. The risk-averse decision maker would prefer asset A over asset B because A offers the same most likely return with a lower range. So you can see this determines the risk. Asset B has more wider risk, which is maximum minus minimum return. So this is more so the returns are spread. The higher, the more the spread is, the more risky it is. The less the risk spread is, the more concentrated the returns are in a small space, hence there is less risk and obviously there should be low return. But in this example, it's interesting that the return is same, most likely is 15%, which is the average return. However, the risk varies. So the risk is most likely reflected into the pessimistic versus the optimistic returns. So they are far away in case of asset B and they are closer to each other in terms of asset B. So here you can also write 23% minus 7% will give you 16%. So let's look at a few of the other statistical definitions. Probability. Probability is the chance that a given outcome will occur. For instance, if you flip a coin, now either you will receive a head or a tail. Now the probability is 0.5. If you do it enough time, you will get 0.5 as an average value or expected value. So a probability distribution is a model that relates probabilities to the associated outcomes. Then we have a bar chart, or basically we have a discrete probability distribution. This type of a distribution shows only a limited number of outcomes and associated probabilities for an given event. Hence, it is shown with the bars rather than a curve. When we go for continuous probability distribution, this shows all the possible outcomes and associated probabilities for a given event. This means it has to be a curve, and we'll look into this in a moment. So let's look at this example and we can move forward with this. NC's past estimates indicate that the probabilities of the pessimistic, most likely, and optimistic outcomes are 25%, 50%, and 25% respectively. This we already learned in the last example. Note that the sum of these probabilities must equal 100. That is, they must be based on all alternative considers. So we cannot have a probability equals to 0.25 plus 0.5. This is not possible because these probabilities do not sum to 1. So what we have one scenario left for which we need the probability, which is 0.25. So remember, probabilities always sum to 1. Let's look at the bar chart or discrete distribution. In discrete distribution, we have number of outcomes and number of probabilities are limited. Now you can see, you remember this returns that we have shown: pessimistic, most likely, optimistic. So in pessimistic case we have 13% for asset A, and optimistic is 17%, and most likely is 15%, and these are plotted here. So we have 13%, and then we have 17%, the most, and this is the most likely, or on average we'll get this one, which is the highest return, which you can see that this is 50% probability, while both of them have 25% probabilities. In case of asset B, we have the pessimistic is 7%. So this is basically, here comes the 7%, which is here, and then we have 15%, which is here, and then we have 23%, which is here. And the probabilities are 25% for this one and 25% for this one, while 50% for the 15% return, which is the most likely. Now if you look at asset B in A and B and compare it, one thing is pretty sure, that you have the distance between these returns and the distance between these returns for asset B is different. So asset A are more concentrated in one space, in a limited space. So it's basically 17 minus 13, and that is 4%. So in between 4%, so the range is 4%, hence they are low risk. When the returns are spread, it is possible that different returns or different outcomes can fall in between these returns, hence the risk is high that you will actually get the returns which is pessimistic, most likely, optimistic. So if the range is high, the more space, more returns can vary within that space, which is here it is around 16%, the ranges. And you can see that this range is high, hence high risk. Compared to discrete probability distribution, a continuous probability distribution has a smooth curve. You can see this smooth curve in the form of bell-shaped curve. Now this bell-shaped curve is given for D, and asset C has more peak. Now what is important about these curves? That how much data falls within the curve. So here you can see the curve holds a large amount of data, Why we are interested about data in the curves? Because these are the extreme values, extreme returns or losses. So if there is a huge crisis, the returns will start falling in this, and if there is a huge gain, the returns will fall in this. Here what we call it is deviation from the normal. Normal is 15%, but you can get a higher return here, and you can get also higher return on this place. Loss, sorry, here is loss and here is gain. So this is the positive side of the curve, this is negative side of the curve. If you look at the yellow curve in the middle for asset C, this is the small returns can fall in this curves. So some stock returns will have blue curves, and hence they have high returns or losses falling in the tail, while there will be certain assets will have small returns or little returns falling within these tails. Now the yellow is mostly less risky asset. The asset C is less risky assets, while asset D is a highly risky asset. But asset D pays a much more, and it compensates the investor for the risk taken. How do we measure risk? Now this is, we already discussed the range, but range is a raw form from maximum, which is maximum return minus minimum return. Now there is possibility that some of these returns are outliers. Outliers are those values which normally do not exist. They happen once in a while, hence the range will be disturbed if these outliers are taken into account. So we need a more robust method to estimate risk. Standard deviation is one of it. It is the most common statistical indicator of an asset's risk. It measures the dispersion around expected value. What is the expected value of a return? So expected value of a return is of an investment is expected to produce over time. R bar equals to Rj, where sorry, is equal to j over 1, and then is multiplied by the probability of the return j. This is how we measure an expected return. So normally you would have seen this in the form of mu equals to R return over n, sum of R return over n, where n is equal to 1 to n. So this is what we have seen. However, we are more interested in the form that has been written here, and I would want you to remember this, that every return has 5%. For instance, there is a return, there is always a probability attached to it, PRJ, and that probability actually defines how this return will whether this return will occur or not, or how much it will occur. For instance, if there is a probability of 0%, then it will not occur. When we take average, we assign equal probability to all returns. Hence, normally we don't see PRJ there. Let's look at this example again. So we have been given probabilities and returns, and we are going to calculate the weighted value, which is the when we multiply probability with the return, we'll get the weighted value. Now asset A has 0.25 multiplied by 13%, that gives us a value of 3.25%. Similarly, we will have 7.5 for the other, and then we have 4.25 for the optimistic case. In case of asset B, and if you add it all together, this will give us 15% return. Similarly, if we go for asset B, we will have we can multiply the probability with the returns, and we will get the 1.75% return. For this most likely case, we will have 7.5%, and then for the optimistic, we will get 5.75%. The total will be equals to 15% again. So let's put it in a formal form. Let's formally write the standard deviation of returns, which is normally represented by sigma r. So sigma r equals to sum of returns j is equal to 1 to n, which is r j minus r bar, and that's square. So please quote it as r, not gamma. It's about my writing. And then we have probability of rj. So this is how we calculate it for standard deviation of an asset. And you should always remember that high standard deviation means high risk, and standard deviation is, let's say, 25% means the asset return can go up by 25% or can be fall by 25%. So it's more of a variability in returns, variability of returns, not static. So it's not 25% will always go down. No, it's 25% can means that returns can go up by 25% as well as it can fall by 25% as well. So let's look at the another example. We have the same asset A and B, and now we want to calculate the standard deviation of asset A and B. Previously we were looking only at range, so we upgrade the example to include standard deviation. So we have rj given, r bar. So I'll rewrite the formula here, which is sigma r equals to summation of j is equal to 1 up to n, and then we have uh, rj minus r bar square. This is our formula, which is, and after that we have multiply by PRJ, probability, and finally we have to take a square root to get the standard deviation. So the term inside the square root is called the variance term. This is the variance term, and since variance cannot be clearly interpreted, hence we take a standard deviation to get the real interpretation. So rj and r bar, then we calculate the, so this is, and then we have r bar, which is the average, which is 15%. If you remember, we did calculated that. And then we have the difference between the two given here. Then we have the square, and then we multiply by the PRG, which is the probability, 0.25 for pessimistic, most likely is 0.5, and then optimistic is 0.25%, 0.25. The sum of these probability is equal to 1. So when we multiply these two terms together, we get 1%, 0, and 1. This is the total comes out to be 2%. So this is what we get for the variance. This is called the variance term. Now we take 2% and we square root it, so we get the standard deviation, and the standard deviation comes out to be 1.41%. So remember, the variance is the formula inside the square root. Once we place the square root on the variance formula, we get the standard deviation of return. So this part is called the variance term and not standard deviation. Once we put a square root, that will be the standard deviation. Similarly, for the asset B, it is calculated. This is the variance term. Again, I'm emphasizing again and again so that you remember it. Variance is 32% when we multiply the terms and total it, and then we have 32% variance. We want to calculate the standard deviation, which is well interpreted and it's clear, and it can be very useful as well. Variance is also very useful. However, for the time being, we limit our discussion to standard deviation only. So take the square root of 32%, or it's already given here, and so we get 5.66%, which is the standard deviation. So for asset B is 5.66%, for asset A is 1.41%. So asset B has high risk, has high risk compared to the asset A. Although their returns or average returns are same. You can see here historical returns and standard deviation on selected investment are given. It's the time period. So for the treasury bill, treasury bonds and stocks, we have 3.9%, 5% and 9.3 nominal return. The standard deviations for treasury bills are 4.7, 10.3, and 20.2 for the treasury bonds and stocks. Now, if you we leave this for a while. We'll come and discuss it in the next slide. Um, Now, 3.9% treasury bills, as we said, it's a risk-free rate or risk-free investments. So it has the least standard deviation or least risk or least fluctuations. I'll we risk, variations, fluctuations. So we have different names, and all means that it is standard deviation. Bonds which are long term, and there is long term, hence these have this time related risk, time related uncertainty. Even if these are government bonds, they are long term, and this in turn this intrinsically give time related uncertainty. Hence there is a higher risk compared to the T-bills. And then we have common stock. Common stocks have the highest risk, but they also compensate that risk with the higher return compared to the treasury bonds and bills. So now, uh, how do we uh, um interpret these when it comes to probability? So we use bell-shaped curve. In statistics, it's called normal distribution. Now, normal distribution is a bell-shaped curve, symmetrical on both sides. So you can see it's symmetrical on both sides. Very smoothly, the tail starts from 0 and it goes all the way to the other end. And the distribution is symmetrical, hence the return, the mean return, it falls right in the middle. So my drawing is not that much good, but this, so 68% of the data falls for each one standard deviation far away. So returns are, mean return is in the middle, then return is either on this side, one standard deviation away, or the plus side of one standard deviation away. The same is this two standard deviation means that the returns are two times the distance away from the R on the negative side, as well as this is for the positive side. Now 68% means that we have around 34.17. These are the values or amount of values that falls in this area in one standard deviation away. So the values or returns falls 34.7 on the positive negative side, on 34.17 on positive side of the mean value, and they are one standard deviation away. Now as you increase the area, 95% means that it falls here. This will include all of them, which is around 47.7, and here it is 47.7, and then we have the 99% area. The 99% area means we have 3 standard deviation away, which is this, and it has the values that the returns that will fall within this area would be around 49.8% on the plus side and 49.8% on the negative side. So both sides have 49.8% equal. It's symmetrical. Symmetrical means that what happens on the left is also is on the right side. Now normally we use the formula to calculate the range or the standard deviation from the distribution based on return plus minus the standard deviation. If we are using 68%, then it will be one standard deviation, which is given here. When return, we are finding the range of the returns, two standard deviation, then that will be around amount of area that it covers is around 47.7. And then, so sorry, it's not 47, it's 47 plus 47, which is 95. So this will be on both sides. That comes out to be 95%. And R plus minus 3 standard deviation comes out to be 99%. So I'm avoiding the decimal points, although there is decimal points also, 95.4, 99 point something. So this is so if I want to find a return specifically to the bonds, so that would be, for instance, for 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 five. So we, in the last slides, we saw that the treasury bonds have 5% return and standard deviation is 10.3%. So what is the range that I get? So if I insert this for, let's say, 99%, that will be 5% multiply 5% plus minus 3 multiply by, and the standard deviation is 10.3%, and that will give me the value, will give us a range of minus, I'll write it here, minus 25.9 minus, so this is the range. So this is minus, first we evaluate the expression for minus and then we evaluate the expression for plus, which is plus 35.9. And if we do the same for the stocks, common stocks, which has 9.3% return for a standard deviation of 20.2%, we will have the so you can insert in this equation, which is for 99%, that will be 9.3% plus minus 3 into 20.2%, and that will give you a range of 51.30. So it's a negative 51.30 and plus 69.9. So you see the range is higher for the stocks compared to the treasury bonds, and that is because stocks reflects the risk. The risk is higher for stocks compared to the treasury bonds. Now, what is coefficient of variation that we saw in the table? The coefficient of variation is basically the standard deviation of return to average return. It's kind of a measure to compare different investments. For instance, if for return, if the CV is high, you see this terms or coefficient of variation is higher, this means the investment is risky. If it is low, then this means that the investment is less risky. In other words, it tells us the return, the risk per unit of return, or for, in other words, for every dollar of return, for every dollar of return, how much risk I am taking. So it's kind of a measure that tells us the riskiness of the investments given the return. So there are two variables involved, hence a better measure for comparing returns, risk and returns of different assets. Now let's do an example for this. We already have that example. Just want to calculate the coefficient of variation for A, which was 1.41%. If we divide that with 15%, the average return, we get 0.094. There are no units for this ratio. Coefficient of variation of B gives us 5.66%, which is divided by 15%, gives us 0.377. Clearly, the asset B is more risky compared to the asset A. It's a nice addition to a tool for measuring risk given returns on different assets. Now, in risk of a portfolio, in real world situation, the risk of any single investment would not be viewed independently of other assets, because we do not look at one asset at a time. We have multiple assets, and new assets comes, old goes, some are bought, some are sold. Hence we have different assets at one point of time and all affect each other. So new investment must be considered in the light of their impact on the risk return of investments portfolio of assets. So this means that if a new investments enter into my portfolio, how it will affect the risk and return of the entire portfolio. The goal of financial manager is to create an efficient portfolio, a portfolio that maximizes return for a given level of risk. So let's keep this concept in mind, that we all, and as well as the portfolio managers, would be looking forward to structuring or constructing a portfolio that offers maximum return for a given level of risk. How we calculate the return of a portfolio? So the return on a portfolio is a weighted average of the returns on the individual assets. So now we are looking at entire portfolio of assets. This is the weight of the first asset multiplied by the return of the first asset, so gives us the weighted return of the first assets of the first asset. Similarly, this is for the second asset, then so on for the nth asset, and we can algebraically define it as sum of weights, where weights j is defined as equals to 1 to all the way to up to n assets in our portfolio, and return is the multiplied by the return, which is also j for first assets to all the way to the n assets in our portfolio. Let's look at an example. J purchases 100 shares for WM at a price of $55 per share. So his total investment in WM is 5,500. He also buys 100 shares of CS at $25 per share. So the total investment in Cisco stock is 2,500. Now we want to see the entire portfolio, and we want to see the weights of the portfolio. So if we combine these two portfolios, we have 5,500 plus the 2,500 investment, that gives us a total portfolio of $8,000. Now, of this $8,000, we have for the WM portfolio will be which is 5,500 divided by 8,000, that gives us 68.75%, while for the CS we have the 2,500 divided by 8,000, and the weight is right now and we have 31.25%. You can also do a small trick. If you have two assets, so the last asset left is, you can subtract 100 minus 68.7, whatever is left is the rest of the asset. Anyway, we move forward. The first will be the weight of so we can say this W1 equals to, which is WM, is 0.6875, and W2 equals to 0.3125, and when you add it, the two weights, that will be equals to 1. So weights always equals to 1, sum to 1. Now we look at the uh, example where we calculate the expected value and standard deviation of returns for portfolio XY. Now these are created by combining equal portion of X and Y assets with their forecasted returns below. So this is as asset A, so number of year, so 14 to 18 we have. Then we have asset X has 8% forecasted return for 2014, then Y 16%, and then we have weighted calculation, which is equally weighted. So equal weighted means we will have 50% invested in X and 50% invested in Y. So this represents the 50% here, and this is for B, so X and Y assets. So 50% multiplied by, which we convert into 0.5, multiplied by 8%, which comes here, and then we have 16%, which is coming from here, and then we have equal of 12%. Now you'll be surprised when you calculate all of them. These all are 12%. The example has been designed in such a way that all comes out to be 12%, and the average is also 12%, which is return of the portfolio. So now if it's all 12%, what do we do? We calculate the risk. We see that what is the risk of the asset, and using the same standard deviation formula we can calculate for all the assets, and we can see that it is 12 minus 12, which is because this is average, which is 12% for all entire portfolio. This is for asset X for 2014, then 2015, 2016, then 2017, and then 2018. And 5 minus 1, which is basically n minus 1, it has to do with the degrees of freedom, and the concept will be more clear in statistics class, but basically degrees of freedom is how many constraints are imposed on the equation. So we are imposing only one constraint, and it will be more appropriate to discuss in statistics class. You can see the answer of all of them are 0 as usual, as we saw. So all of them are 0, and comes out to be standard deviation is 0. So there is no risk in this portfolio while it will pay you 12%. Now look at the concept of correlation. Correlation is a statistical measure of a relationship between two time series or two series of numbers. They are positively correlated when it means that two series that move in the same direction, and negatively when they are in opposite direction. Then we have a measure that brings this correlation into a form that we can understand, and that's called correlation coefficient. It is a measure of the degree of correlation between two series. So positively correlated, perfectly positively correlated will have +1, while perfectly negative correlated will have correlation coefficient of negative. This is how it is depicted. So positively correlated for stock N and M, they are moving in the same direction. If you say this goes down, M also goes down, this goes up, and so on, so on forth. So they are very, very highly correlated. This is example of perfect correlation, and perfect negative correlation is given here where they are opposite. If N goes down, the M goes up. If N goes up, the N goes down. So they are almost oppositely moving at every point of time. This is the example of perfectly negative correlation. More on correlation. So we have this straight line drawn for you. This is +1 and perfect positive correlation, and this is -1, which is perfect negative correlation. Now 0 represents actually no correlation. In between, I have between 0 and +1, 0 -1, I have jot down few of the points. The +0.7, +0.5 correlation, +0.3 correlation, 0.2, and same on the negative side. Now, as we move from 0 to +1, the correlation increases, and as the correlation increases, the risk increases. So at 0, there is no correlation. The two assets are moving in any direction randomly. We do have no idea. There is no structure between them. But at +1, we know that both will move perfectly together. When one moves with 1%, the other also moves with the same proportion of change. That's 1%. At 0.5, what happens? Let's say asset A increases by 10%. Then asset B is supposed to, asset B is supposed to increase by only 5%. Now this difference in increase actually gives us a space, and that's what we call diversification benefit. So low correlation, between 0 and 0.3, there is no strict rule, but if it's less than +1 and closer to 0 is better, and if it's closer to less than 1, anything less than 1 would be acceptable as correlation that creates diversification benefit. Now you can see on the other side On the other side, in the negative side, when we move towards -1, the two assets are exactly opposite and moving in the opposite direction. So if one increases, asset A increases by 10%, so asset B or stock B will decrease by 10%. So it's exactly opposite at -1. So anything less than that will provide the space between the two assets for diversification benefit. Again, the closer it is to zero, or low correlations, are these are the low correlation regions that will provide a better diversification compared to the higher regions. So to reduce overall risk, it is best to diversify by combining or adding to the portfolio assets that have lowest possible correlation with the portfolio. Now this will reduce the risk. This can be seen from another example, that asset F has a return which moves with the passage of time in this direction. The other is not exact correlation, but a mimic of the earlier asset F correlation. So asset G and F, when combined, the average return would be somewhat in the middle of both returns and asset G, or an average of asset F and asset G. This provides diversification benefit because asset F appears to be more risky and asset G appears to be less risky. So combining both, we can reduce the risk and while keeping the return to somewhat acceptable levels. You can see this from this example again, in which we have uh, 2014 given. From 2014 to 2018 we are given, and then we have X, Y, and Z, three assets, and their returns are given, and their expected value, which means average, given 12%. This we have already done it. So standard deviation, we have already calculated this, 3.16. Now we have portfolios. If we combine XY with the 50% investment in X and 50% in Y, and another portfolio which is 50% X and 50% in Z, what comes out? So if you calculate the weighted average return, we'll have 12% expected value for both. However, this time we have zero standard deviation for XY, but for XZ we have 3.16%. Obviously, now we have more information to make our choice. Hence, XY will be preferred over XZ, because XY does not have any risk, while XZ has 3.16% risk for the same level of return that both portfolios offer. Consider two assets, low and high, with the characteristics described here. So low has 6% and risk for the risk of 3%, while high asset has 8% return, which is higher than the low return, and risk is also high. Now the performance of a portfolio consisting of asset low and high depends not only on the expected return and standard deviation we said, but also on how the two assets are correlated. So as this information was appropriate for single assets, but now when we have a portfolio, we have to also structure or find the correlation between the two in order to see that how both assets, when combined together, can create new set of risk and returns. In this slide, you can see that we have correlation coefficient given on the y-axis, and on x-axis we have portfolio returns. Now for a perfectly positive correlation, these are the range of return between 6 and 8%. Between low and high, 0 is here, and then we have the range of risk for all the three portfolios. So return is almost same for all of them, while range of risk we have on the positive correlation we have between 3 and 8%. 3 and 8%, while here we have between 2 and 8%, and here we have maximum risk of 8%, while it is 0 to 8%. So separately, if we evaluate the two assets, we have risk return given here. While we combine them in a portfolio, we have a longer range of risk, and we have more appropriate set of risk available for the same set of returns. The same idea applies on stocks. So stocks from other or assets from the other countries with business cycles that are not highly correlated with the US business cycle reduces the portfolio responsiveness to market movements. So it means if a shock comes and if stock falls, the entire portfolio will not fall in value as much as if the entire investment was made in a single asset. Then over long periods, internationally diversified portfolios tend to perform better, what research tells us, compared to domestic portfolios. Also, we know that over shorter periods such as a year or two, internationally diversified portfolios may perform better or worse than domestic portfolios. So these are the outcomes of research. Currency risk and political risk are unique to international investing. Obviously, they have to be taken into account. So let's review the learning goals. We worked on risk, return, and risk preferences. Risk preferences with respect to types of investors. We also discussed the procedures for assessing and measuring the risk of a single assets. This was to how to calculate the return, the risk in terms of range, standard deviation, and then variance. We did the same for the portfolio as well. And we discussed the concept of correlation. Correlation is basically the structure between two assets in terms of risk and return. And um, we also discussed the concept of diversification, especially with respect to international assets. And this is all for now. Thank you very much.